I get the vibe that you're distant. There's something about you that's different. I see it in your eyes. Something isn't right. Tell me again what I'm missing. 'Cause you're fading out. We've been here before. Tell me again, just tell me again, and I'll make it right. Don't go through that door. Tell me again, just tell me again, and I'll make it right. It is a lie when you tell me that nothing is wrong, just leave it be. But I see it in your eyes. Something isn't right. Tell me again what I'm missing. 'Cause you're fading out. We've been here before. Tell me again, just tell me again, and I'll make it right. Don't go through that door. Tell me again, just tell me again, and I'll make it right. I will make it right. I will make it right. Tell me again, just tell me again, and I'll. 'Cause you're fading out. We've been here before. Tell me again, just tell me again, and I'll make it right. Don't go through that door. Tell me again, just tell me again, and I'll make it right. Tell me again. Tell me again.
Rodney, how are you?
Fantastic. How are you, sir?
It's happy Tuesday to you and everybody that's going to be tuning in afterwards. We've been getting some good activity on Facebook. I know you don't monitor that, Rodney, but just saying that's the good news that we've been getting that. So that's, A lot of times you just can't see things.
Did you hear that bell?
I did. What was that?
It's I'm on my Mac, right? So anytime I get a text, it's the bell's coming in.
At the very top on the right, there's two little things that they're like this. If you click on that, you can click do not disturb, and that'll stop.
On my phone?
It'll stop everything. Yeah.
Oh.
Doesn't matter. You don't need to do that now. So did you do anything fun over the weekend?
I did,
Nothing.
I finally got some exercise, played 18. Good morning, Angie.
Hi, Angie.
Played golf with my son, my youngest son, Saturday and Sunday. My oldest is at UT, and unlike me, I was broke in college. I don't know, but he got to go to Talladega this weekend. So I'm like,
Jeez.
how are you in school and getting to go to Talladega? I didn't do stuff like that.
Because his dad's Rodney. That's how.
He's made the dean's list like I think 3 out of 4 semesters, something like that. So I'm super proud of him.
Hey, listen, I tell you, he's going to be taking care of us soon enough. So we need the smart ones in there, we really do. Yep. So there's just been so much going on. This is going to be a little bit different today. Thanks to Angie and others as well. Rodney and I have discovered the world of reaction videos. So we're going to do some of that today a little bit. But we're going to start like we always start, which is with Rodney's Rate. I never get tired of that.
Nice. Jackson 5 intro. You got to like it.
I do, man. I'm telling you. I'm never changing that.
You see the mortgage-backed securities here. We're up actually a little bit of a tick today, 31 basis points. I will go to let's look at I'm sorry here. The market's overview here and get a sense of what's going on. You can see the mortgage-backed securities are up 31 basis points, which is good. It means they're paying 31 basis points more than they were for this exact product this morning. Treasuries, usually the opposite, like when our 10-year treasuries, if it's going down, usually our rates are getting better. And if I scroll down just a little bit, you see those green little candles on the right side of the chart?
Yes.
The last few days, we are starting to see our little, 3 or 4 days of improvement again here. So that's awesome. We always love that. And
yes.
One thing we look at is that this service always tells me to look at is moving averages and floors of support and things like that.
Yes.
So this right here, it looks like you see this line right here. That's our ceiling. It looks like it hit that ceiling and bounced off of it, and it's it's stuck, but it's stuck between the floor and the ceiling there, as you can see. So
yes.
Pretty typical. But it's trying to bust through that ceiling, which is a good thing. It's not trying to bust through our floor way down here. So,
and again, this is the inverse of what we're expecting with what we see on rates. If that goes up, rates go down. Correct?
Yeah, that's correct. Anything green means that that we're getting more money for that rate, and as you get more money for a rate, it brings into lower rates. You can get the lower rate for a little bit cheaper than, the higher one. I guess not to try to confuse you. Basically, when it pays too much money, we go to a lower rate.
Got it.
Right?
Got it. Yeah.
You just don't keep the rate the same and keep making more money. People want lower rates. So that's how that works.
Maybe one day you can do a training with us on that, because it's that can be baffling, And I think that's why there's so much discussion on it, is it's confusing,
Yeah, and you see right here, the last time we've had a alert to lock was on April 17th, right there. April 6th, 14th, they told us to lock right there. You see that little triangle, uh, and so that's outside of that. They haven't been pressing us to lock in at any certain time. So
And that's a good sign. That's a
that's a
good
good
sign.
sign. That's it for the market.
So hang on. Here we go. There we go. So I'm going to get rid of that. Do you have any? Well, if you have anything else that you want to share, you can do that. So just letting you know. Sorry. There we
No,
go.
it's I'm kind of like everybody else. It's I guess I'm kind of going with the flow on this opinion of kind of the market may steadily improve for the end of this year, and then the big market changes may be, as far as significant increases in loans and things, probably the last quarter of this year, later this year, beginning of next year.
Yeah, I know for me, I would be happy without any huge variations. That's what stability is all I'm trying to say, because I've got buyers out there and I've got sellers coming, and we've got an auction coming, which is going to be really interesting because an auction is the purest snapshot of the economy. I mean, I don't think you get much more pure than that. Of course, you're dealing most of the time with cash, not always, but mostly. So that's going to be an interesting thing. And now I'm going to tell you, this, there is a lot of money out there, a lot.
Yeah.
There's a lot. Oh man, there's so much money out there. Man, oh man, oh man. So what I wanted to start this off with, if you don't mind, Rodney, was and I think that we've been talking about this. I'm going to pull up, does the LLPA graph apply? Is that what this topic is about? That orange and yellow graph, this one, right?
Yes.
Okay.
That is our new. That is, yes, that's the thing that went into effect. May 1st, or going
It's
into effect for
go.
deliveries, right? Yeah. So it's been in effect for a while, right? So
So,
even though
but
there's a date on there of May 1st or May 3rd, whatever that is, any loan that we have right now that's closing, I already have these LLPAs in there because I'm still just delivering these to Fannie. So, it's they're already in there. So the people who's like, oh, May 1st, the world's going to crash. Well, you missed it. It should have already crashed because they're already in there. The pricing's in there. You know
now,
what I'm saying?
I do. I absolutely. But let me ask you some questions, though. I mean, don't come to a conclusion too quickly for me here. Don't ruin it for me.
No,
Can you define an LLPA easily, or is that something that you can define?
yes, it's loan level price adjustments. Do you want to pull up that chart again?
I do.
And
Bing.
yeah, all this is loan level pricing adjustments. If you look at the top of the graph, what that's referring to is the loan to value of the home. So if you're buying at 30%, if you're putting 70% or more down, you're going to be in that far left-hand column, to where you basically see no adjustments to your loan because you've got such a low loan to value, all the way down to a 660 credit score. And the credit scores are on your left. Okay.
Okay.
So when you're doing a loan, and we have a pricing engine. So all this is figured out. All this is already plugged into our pricing engine. So we just plug in the parameters. And when we pull up the pricing, all this is already added in. It's added in. It's taken into consideration, like if you have a state adjuster, like if I'm dealing with, say, U.S. Bank, and U.S. Bank says, well, we love Tennessee. We're going to pay Tennessee 10 basis points on every loan they deliver because we love Tennessee. So that would be on top of this. So you have these loan level pricing adjustments, and that's all it is just kind of a risk-based chart here, depending on how high your credit score is and your down payment.
Okay.
So you can see the old versus the new, right? The higher LLPAs, and then if it's green, it's lower. It got better. So if you look at the bottom, basically the top, the right-hand side and the bottom is better. The middle got worse. And the other ones are somewhere in between. But
Okay.
what that's saying, Andy, is like everybody with a high loan to value or a lower credit score benefited from this change. Okay. Like I said, we've talked about it before. We think the government is making some changes to try to help home ownership in America, right? So we think that Fannie Mae and Freddie Mac helped us out in that green spot.
Okay.
Now, what people are hanging on to is that the red part has gotten worse. But now, what I challenge people to say is it still helps homeowners buy houses. I don't agree with everything else they're saying, because the way I feel about it, a guy with or a family with an average credit score of greater than 780, you see if you go to 80 to 85% loan to value, the very top line, it looks like it got worse by like 0.125%.
Right.
This, in my opinion, a family putting that much down with that kind of credit score can't afford this. Like the people who are doing those loans, 740 scores, large down payments, this is not going to affect them. Yes, it is. They may pay more today than they would have yesterday, but outside of that, there's no change, right? They still get lower. They still get a better rate than somebody with a higher credit score. And I think that's where everybody's misconception is like, oh, the lower credit, the higher credit scores are paying for the lower. No, that's not what happened. In my opinion, they just adjusted this scale to bring higher and lower credit scores closer together.
And so when we hear things like this, it says, wait, this news is from January, which you said right up just only moments ago. I mean, we've been talking about this since last December. Not to beat a dead horse, but it was significant, so that's why we brought it up. Why is it that people are talking about it now is the question. Is it just because it gets clicks, it gets attention? I mean, because what you just said seems to be getting the lion's share of the attention.
Right. Yeah. Everybody, like, I think I ended up telling you, I was like, when I first brought it up to you, I was like, Andy, man, there's a lot of crazy press going on about these LLPAs. Let's throw it out there and just talk about it.
Yeah.
Now, would it have been nice if everything would have been lowered? Sure. But overall, see, the problem with, in my opinion, the problem with the way the loan products that we have is conventional loan. And before these LLPA changes, and you had a 660 score, a 640 score, you were punished to go conventional. Your rate was awful. It was another 2 or 3 points on, than you would have paid if you had a 700 score, which the gap, in my opinion, was too far between somebody with really good credit and not so great credit. Because we're not changing the underwriting guidelines. Fannie is not loosened up on lower credit scores. They're still underwriting the same way. It just gives the lower credit score, in my opinion, a chance to buy with a conventional loan versus being forced into an FHA product or some other kind of down payment assistance or something like that. it gives borrowers more options and potentially a better program for nothing. You know what I'm saying? I mean, they
Yeah.
improved this, in my opinion. They didn't
Right.
make it worse because the people, honestly, the people, and I hate saying that. It's like I feel like a government saying, "Well, they can afford these taxes," but honestly, they're not going to tell the difference in this, right? The 780 score is not my rate will be the same as somebody over there because they had the same LLPAs I got. So
Right.
it's not like they're being punished. It's I think they're helping the other people more. Is the way
And-
I look at it.
yeah. Well, and I think that that's what they're trying to achieve. So the difference between conventional and FHA is you've got a MIP that never goes away now, right? On FHA, isn't that
Mm-hmm.
right? And
Mm-hmm.
so if somebody gets locked into that, if they don't refinance into another product, they're locked into that MIP for the life of the loan versus, if I'm not mistaken, a conventional after 78%, then that can go away. Is that correct?
Correct. Conventional. There's some very supportive laws for the homeowner to be able to get rid of that PMI in a couple different ways. So it's good.
So as a lender, and you've been doing this a long time, and you've seen, that's why I put so much trust in you, because you've seen it all. I mean, you've seen good markets, you've seen bad markets, you've seen people lose everything through foreclosures and short sales, and we've seen both sides of that. My question to you is, because at this point, as a lender, I'll bet, and I know you would never judge anybody, but I bet you have a pretty good sense of things when you talk to somebody initially, if they could actually buy a house and manage that situation successfully. Is there any truth to that? Do you have a sense of that?
Um, you know, not necessarily in that area. I see why you say that, but really, it's kind of like we see numbers all day. We see, what I have a sense for is what I think, like the approval systems will take. Like
Right.
I'm like, I see, okay, they got a 680 score, but a high debt to income ratio, but they've been on their job for 15 years. I think that like the AUS or DU desktop underwriting or loan prospector, desktop originator, whatever you use, I think we get good at kind of guessing what those systems take.
Right.
'Cause we end up saying things like to each other, well, it looks like Fannie loves reserves or Fannie's hating high ratios or whatever it is right now with the new change. So we just kind of track it and see what our approvals look like and discuss it amongst ourselves because when you have several loan officers, we're all running these approvals. We just offer some feedback, like, man, I can't believe it ain't taking this, or I can't believe I did get an approval, and so we just have conversations like that to get us to learn the system, not necessarily like, could this couple be sustainable home ownership? Because Andy, there's a lot of other stuff goes on with personal stuff. A lot of times, sometimes we can't even count people's second jobs because they haven't had them long enough,
Yeah. Yeah.
and things like that play a factor in that as well. But I guess I think where our expertise comes in, or mine, is that we have a good idea. We start having a good idea of what the computer likes.
I think, and I hope you're okay with me saying this. One of the reasons that I have such respect for you and your crew, all of you,
Thank you.
is that over the years there's been situations. I mean, I know that if somebody wants a loan and they qualify, they get the loan. That's it. But I know that you're courageous enough to sometimes say, maybe waiting a minute or getting a little more resources or having a more of a down payment just is a better idea. Not that you would ever stop anybody. That's not what I'm saying. Anybody's listening. What I'm saying is to have somebody that I work with that has the integrity to say, of course you can get a loan, but have you thought about this? Maybe it's smart to wait a minute, And that's the reason I asked you that question, because I know you're not judging anybody. It is a numbers game, and if they qualify, they can say that, do it anyway.
Right. Yeah. Oh, yeah. It's I offer, of course, I probably offer my advice too much, but I give my opinion. But ultimately, it's the customer's choice. But
Yeah.
to whatever loan, whatever decision they're making, it only gets. I've only had to do it like a couple times where I felt like I'm like, hey, you really don't need to do this. Like and it's only been on a couple refinances, and and honestly, the people that gave me guidance on it, they just said, hey, just you gave them your best guidance, and they want to do what they want to do, which is what's they feel is best for them.
Yeah.
Uh, and so I would just put my guidance in there that, hey, I suggested that they shouldn't refi this loan, and put it in the file, and the investor's seen it, and they're like, yeah, we understand. People still get to do what they want to do.
Yeah.
Right?
Yeah. But I mention that because that is a professional quality that I just don't think that there is nearly enough of. And so, I mean, I'm sincere when I say I applaud you in that. And I just wanted to
Well, I appreciate that.
I wanted to make it clear that I wasn't asking a judgmental question. It's just that you've seen enough, because I've seen enough home buyers that even before I get them to you, just on a conversation, it's like, boy, I don't know, we'll have to let Rodney work that out with him.
Yeah, I appreciate that. I think it just, one comes a little bit of maturity. Shoot, I'm pretty old, and it's
That's
you, I
Are
just
you?
you couldn't do a loan. I couldn't do a loan for somebody if it's not in their best interest, right?
There you go. Yeah.
I'm not in that spot in my life, right? I do not, I don't need one loan that bad. We don't want to make any bad decisions like that, and our whole group's like that. So we're very blessed like that.
And I think that the word gets around. So going back to this, so in your opinion, and the reason I asked that, do you think new home buyers with less than stellar credit, I mean, who has I don't know, but very few people have perfect credit. I don't even know it does exist, I think, but like there's people, they're trying to come up with ideas. Like there was one guy said, if you lower your credit score intentionally, will that give you a better rate? I mean, they're trying to work around this deal.
Well, the one LLPA is the thing about it is that if you got great credit, you get the best deal. If you got worse credit, although now you get to play in the conventional sandbox, you didn't get to play in that sandbox earlier with bad credit. So
Right.
now you get to play in that sandbox if your credit wasn't stellar. So that's what it's opened up. So no, if somebody intentionally goes out and hurts their credit score, you will pay a higher price for your mortgage. Period.
It just broke through, because I can be really dense sometimes. Because this is, anybody that knows me, I'm not a lender. I don't play one on TV or YouTube or any place else,
Look,
There
I'm
we
giving
go.
Chick-fil-A a shout out here. Maybe they'll hook us up with a free sandwich or a fry or something next time. Or sponsor our podcast.
Yeah, Chick-fil-A. Okay. All right.
So just throw that advertisement in the middle of your speech. Thank you, Andy.
I don't know what to do with that. I think it takes 5 seconds of being actually on camera.
Okay.
I don't know how that works.
We'll keep
Isn't
going.
that interesting, though, that your take? I love it. Here we go. Now we're going to get in. Yeah. Yeah, baby. And that's actually coffee in there too, babe. But it just broke through what you just said. that for all the people, and I'll show you some of these, I'll read some of these headlines, even though I know it's too small. Angie, I know this, don't get mad at me, but I'm going to do it anyway. I know it's hard to read, but these are the headlines from the topic that we're talking about that basically says the middle class is paying for lower income. That's what it says. And it says, here's some of the headlines. It's going to hit the consumer hard. Those with higher credit scores may pay higher mortgage fees. We've already established that may be the case. Real estate experts shreds Biden rule punishing homebuyers with credit. Upside down mortgage policy. Now, I do have an opinion on, and I would like your take on this. I'm not trying to put you on the spot, but I'm just trying to put you on the spot. Is that a backwards message for the masses? How else would you say that?
It's, I mean, semi, right?
Yeah.
I semi agree with that, but just understanding how the world works, how business works, it's like Fannie doesn't want to crush their model just to bring in a bunch of lower credit scores. So
Right.
to pass off some small adjustments to the people with, in that middle box there, where it was red,
Yeah.
20% downs and middle, 740, 720, those look like those are red right there. That little bitty cross, right? In that middle right there, that's who it affected, right? But look at all the people who benefited from it. So
yeah, and there's another point that you just made that just got into my head. Of all the loans that are being generated, that's a pretty small cross section. I mean, isn't it?
yeah, it is, but it is a lot that fall into that, right?
It's a sweet spot.
They picked some good boxes, like 720, 740, 20% down. That is a huge part of conventional.
Well, and maybe I think that there's a lot. What Angie has added was, I'm going to add this if that's okay. Sometimes people need a break, especially if they're now on track. And I think what she's saying, and I mean, clearly where I stand on a lot of things, but there's a lot to be said for that. Breathe a little hope, because you know what? First time, but not even first time, just home buyers in general this last couple of years have just been getting beat up,
Yeah.
And maybe a little bit of good news is what's being promoted. Maybe?
Yeah. Throw that one back up here for me. Sorry, Andy. I just want to make one more point about the comment that people comment are saying, yes, people commenting like, okay, the middle class or the higher credit scores are paying for everybody else. That's not even close to being the case, because if a customer hits, let's say they go to 660 to 679 and they go all the way to 95% LTV, okay, that box is green right there.
Right.
That box got better for that one customer only. Nobody paid a higher fee so that person can get that. That box, each of these boxes stand alone by themselves. So it's not like the guy in the top left-hand corner is paying for the guy in the bottom right-hand corner. These are just the new prices. And the way I look at it is that it's opened it up to more Americans or more citizens or whatever that can purchase a home that didn't have it's cheaper for them to buy a home. Yeah, a select few got theirs increased, but it's still a lot better than if you didn't have a good score. It just increased from what it was.
And maybe to move off of this topic, but I've got a thought, if you don't mind, Rodney. I'm going to try this. Whoop, hang on. Maybe make sure I get this right. I'm going to play. This is a little bit of a reaction, And I'm going to play this, and I can see it behind the scenes. You can give me the high sign when to stop. But I'm going to play this on the shared screen. I have an opinion. I'd like to hear what yours is. Hang on. Let's see if we can do this correctly. Good. Wrong one. Correct. Here we go.
You know, so many people have been asking me, hey, Michael, when is the housing market going to crash? What's going to happen? You know, why aren't we seeing, massive price declines yet? Why isn't everything completely falling apart? Well, you don't have to worry about that too much longer, because thanks to the Biden administration, they just passed a new rule, which many of you already know about, that pertains to mortgage lending. And this is going to affect everyone who gets a mortgage to buy a house. And if you want to see guaranteed foreclosures, well, this is a doorway to that. Because
I can't go on. I just can't. I can't. Can I stop there?
Yeah, please. Yeah.
I'm going to say this because this is new term. My people skills kicks in when I have a different opinion, and some of the things that are being said is what I'm not going to say scares me, but it's a concern. And the reason I read all those headlines is that those headlines are trying to get your clicks and your attention. And some of the things that are being said like the middle class is paying for everybody's else. And I don't think either of us, well, you've just said, we don't believe in that. But to have somebody come on this and say, and he gets a lot of attention, to say that everybody's going to be hurt. I could replay that, make sure I have that right. But everybody's going to be affected.
Yeah.
Implying negative. Well, we know that that's not the case, shall we? Ding.
Yeah. Well, yeah. I mean, once you actually like look at that LLPHR and kind of just have a discussion on it, I can't see the argument where they come from with that. My take on this dude though is like, he says, okay, well, people, hey, when's the market going to crash? And I'm like, first of all, who is asking this dude that question? He's got a tank top on. He's got some orange sunglasses, his hair slicked back. Looks like he's walking around in an apartment complex. I'm like, first of all, who's asking you for financial advice? That's the first problem. Second problem is, if you're going to blame Biden, and I'm not a Biden supporter, right? If you're going to blame Biden for something, you've got a bunch of stuff to choose from, in my opinion. But his administration may have gotten these LLPAs as good as he could got them. I'm like, he has helped. What we talked about, Andy, last year sometime, we went over an article that said, and I hate going, I went back to this 100 times, I know. The article said something like, or we had a discussion, how is the government going to carry out their order or their charge to help first-time homebuyers? Do you remember we had that conversation?
Yeah.
And I was like, heck, Andy, I don't know what they're going to do. They only control like Fannie and Freddie, right? So, and then they come out with this LLPA, and I was like, hey, this is part of that. And then FHA come out where they lowered their MI premium, to 0.55%, which is a huge break for especially first-time homebuyers. It saved a lot of money for people.
Like $800 a year or something, right?
Yeah, it's significant. So,
right.
Golly, I mean, pick something else. I mean, Biden's liable to fall off another bike this weekend. Pick something he actually did. But I'll give Biden credit for this. I think he's done a better job, or I think they carried out what they said they were going to do. But I'm like, this dude's in tank top, sunglasses, his hair slicked back. I'm like, man, unless like you're getting out of a Ferrari and you're in Palm Springs or something, like you're a billionaire and you just dress like that, it's like, who would be asking you for advice? It's like, you know what I'm saying? It's, I always tell my kids, I'm like, all these people with flair and all this stuff, you can have flair, but you got to have substance first. Like
Yeah.
you can't be the guy that has flair and never delivers any good information. Like you can't go out and dress like a bozo and then want to get into a financial planner role. Like you've got to actually be, So
And
I
this
don't like
guy's,
who's asking this guy for financial advice because I'm like, there's some people who may not want to ask that. So
yeah, and he's a real estate agent down there, and it's my whole point is that's a hell of a claim to to start talking about foreclosures and stuff if you want, and guaranteed,
yeah.
housing
And
crashes.
there's no data to back that up. There's no data right now coming out that says that we are even coming close to people foreclosing. I hadn't even seen it. I mean, I have banks in our area that's like, I know they don't have foreclosures.
Well, it just so happens. Okay, we've decided we're not on this guy's team, so we can move off of that. We're not on his team. So now that you mentioned, I didn't put this together how this is going to flow, but it sure is going to work. Let's look at one other thing before we close out today. I'm going to skip the middle section and go right to the foreclosures points. And here we go. When we're talking about foreclosures, and you and I have been through this over the years, it's always important, but when it was overwhelming, there was 4 million foreclosures back in the 2010s. There's a bunch. There's reports now. People are starting to watch the foreclosures because when you talk about crashes, you got to talk about foreclosures because that's on the pathway there. And so what was reported was this. Foreclosures are at a record low. The delinquency rate decreased by 53 basis points in March of 2023, which is the second largest decline for foreclosures in the past 17 years. The total number of past due mortgages, including active, has reached its lowest level in 23 years, dating back to 2000. That's some pretty compelling arguments about foreclosures. So let me look. Every state in the U.S. recorded lower delinquency levels in March, and it's specific. It's March. It's not like last year. This is happening now in the midst of everything that we're going through financially. There's fewer foreclosures, with the range from 11.9% in Washington to 21% in Vermont. There's less delinquency levels. And the way that happens is once you go in default, you get a letter, a notice of default, and then the clock starts ticking. And then you have to have a conversation with the bank, and either you do what is required to get out of it, or you proceed into a foreclosure. It's more complicated than that, but that's basically it. Did I miss anything? I don't think so.
No. Pay or stay. Pay or stay.
Yeah. If you pay, you can stay. The active foreclosure inventory of 31,000 was 12% below March 2020 levels. I'm reading these points to make a point, and here's the next one. Black Knight explained that the March data, these lower numbers, was not an anomaly or the start of a new trend, but was due to borrowers utilizing tax refunds or other seasonal revenues to pay down past due debt. Credit card debt is up, but apparently there's a large number of people paying down their debts, right? This is good. So here's the punchline. Black Knight, which is a huge data company. Did you have something you wanted to jump in here, Rodney?
No, I will after you finish your point there.
Okay. Black Knight's new data on the U.S. delinquency rate indicates a positive trend in the housing market as delinquency rates have reached their lowest levels in almost 23 years. This decrease in delinquency rates may contribute to a more stable and healthy housing market with fewer foreclosures and distressed sales. Now, that's a punchline I can get behind.
Yeah. Well, to me, it makes sense, right? One, I'm not seeing any foreclosures, right? I mean, it's like I generally can visually feel or see the trends that are happening across the United States, right? Um, our market is not. Our market is, to me, is a little bit insulated because I think people just feel like it's a great place to live, which makes it a little bit more insulated, like a, not comparing us to like a Beverly Hills or something, but there's only one Beverly Hills, right? So
Yep.
if you want to live in Beverly Hills, you got one spot on earth to do it. So, but my point is that it makes sense. Why does it make sense to me? One, after the crash, everybody knows Dodd-Frank, all the changes, blah blah blah.
For
We
anybody that doesn't know, can you summarize Dodd-Frank?
Dodd-Frank come out with a whole bunch of stuff that was directly related to the crash in the 2000s, 2008. So
Right.
Dodd-Frank regulation stems from a lot of borrower protection, a lot of stuff that's disclosing and making sure the buyers get, a lot of stuff like that, a lot of paperwork responsibilities, and then they made the deal where it has to be basically a qualified mortgage, meaning it has to go through an underwriting process and meet certain standards before it's considered a mortgage-backed security.
Got it. Okay.
That was the one thing that separated last time before the crash.
Yes.
You could go and say I make 10 million a year and I don't have to prove it, and that loan was considered the same as mine, whether I showed pay stubs and had a 15-year fixed. But say with the underwriting changes, the Dodd-Frank and all the regulations that came that were good about that helped, right? And then the second thing is rates. We're at a we've experienced an all-time low in rates between then. And then the last thing is we've also experienced so much equity building over the last several years that there is almost every house from, you take it from 2000 and then you fast forward to 2002, you've got so much instant equity in that thing that it's hard why would you foreclose it? All you have to do is just say, I'm going to sell it if I can't pay it, and I'll take my thing and walk away, right? I'll take my equity and go on.
Yeah.
So, I mean,
Yeah.
there's the foreclosure market is nothing right now. It's non-existent.
It's nothing. And I'm going to add just a thought. Now, this is from the real estate side, from the realtor side. Angie said she'd love a foreclosure outside of Chattanooga, please. Now, I get that. But let me tell you something here about, give you a little peek behind the scenes, BDS on foreclosures. In the early days, meaning 2008, when the foreclosure stuff was just getting started, the foreclosures come in different flavors, is what I'm getting at.
Yeah. Yeah.
And with those, there were some of the most, I couldn't even walk in these places because they were just a tragedy. They were dirty and the copper was ripped out of the walls and it just was awful. I mean, that's what that was. And then as foreclosures became more common, houses actually there was some you go, God, this is kind of nice, Yeah. You could live in them, But there's a difference when people are forced to fall apart in slow motion and they haven't had any money to upkeep their house for 5 years versus one that just had to go because of a bad moment in time. I'm saying there's foreclosures come in different flavors. That's really all I'm getting at.
Yes, and just because the market, when I say the market is non-existent for them, there's always going to be some. I mean, you go out and people go out and get HELOCs or like you said, deferred maintenance really hurts the value.
Yep.
And maybe theirs didn't increase like everybody else's or whatever it is next to whatever. So absolutely, but they're, like it's possible to find a foreclosure outside of Chattanooga or something like that, but it's extremely rare.
It is possible, and it is rare. And I had one more thought on that because I just remember why this works this way. Of this, because I've seen when I'm searching for these folks, I do see, some stuff that's going to auction, which is oftentimes the last stop for, there's short sales and there's auctions. That's like the last stop for a bad piece of property. But for most foreclosures that I see these days, and again, they're few and far between, what's happened is the homeowner has refinanced so many times that they've got zero room left. There's no room. If they sold it, they'd be back in 2010, they'd owe money, Yeah. And when you have somebody that's refinanced themselves to buy time in a house, the first thing to go is maintenance. The next thing to go is taxes. The next after that, it's going to be utilities. And then you're talking about getting copper ripped out, and it's
taking the light fixtures out of the house.
I'm taking the refrigerator because it's all I got. And I get that. But here's the point, and this is why I thought this was important to bring up the foreclosure thing. There was another article that was read, and I think I can. Hang on, and it says, no, is that correct? It says at the top, foreclosure activity up 22% year over year. And the reason I bring that up is to show you that isn't that just spin? That's just spin. It says foreclosure filings on U.S. properties increased by 6% in the first quarter of 2023. 95,000 properties carried foreclosure filings in Q1 of 2023. One in every 1,400 housing units had a foreclosure filing in Q1. All we're saying is we just got done with the facts, with that data company saying it hadn't been this low in 23 years.
Yeah. Somebody's off the point, right? Yeah. I don't know why this has gotten turned this way, right? I don't know why it's turned like if people wanted to raise a bunch of cane about these LLPAs and they're causing foreclosures and all that stuff, they missed the point. During the refinance craziness a couple years ago, year and a half ago, whatever it was, Fannie and Freddie come in and added a full point across the board to if your loan said refinance on it, they added a full 1.00 to the LLPAs on every refinance there was. And I'm like, they're saying the middle class or the higher credit score is going to pay an eighth of a discount point more than they did before they made this change. But I'm like, yeah, so what? A big deal. I mean, you just missed it a year ago. They added a full point if you just refinanced. Think about all the refinances Fannie made, and they added a point to every one of them. It's crazy. I mean, they made a fortune off that, but it wasn't sexy enough to get a headline and get them some clicks.
Thank you, ladies and gentlemen. That was good. God.
Hey, let's see here. I think Philip had a really good question about something about a small surcharge for hedge fund investors when acquiring single-family housing.
Yeah,
you see that question? Yeah.
Hang on. I've got it. Hang on.
I can.
I got it. I found it. Okay.
Me and Phil here is on the same page, and I don't think it should be a small surcharge. Here's what I think: these hedge fund investors that are coming in, and now I think we read a stat, Andy, that they were 20+% of the market that these hedge people were buying single family homes.
Progressive. One of them, yeah.
Or it's because they got $700 billion. It's not because they need homes. It's because they need to put their money somewhere. And they're messing up the real estate. I think, but see, here's the deal. They're not using this money. They're not using Fannie Mae. Like I'm saying, like, yeah, we should charge them 5 points, but guess what? They're not using Fannie Mae money. They're
Right.
using their own freaking money and buying it, and don't even have to have a CD, right? They're just buying it with cash. So I'm like, I wish the government would say every property has to have an option, like before a hedge fund company comes in. Basically, if a family wants it, they have to entertain a family contract before a hedge fund. But that's big business. Somebody with $700 billion like these guys, Rodney with no background back here is going to get overruled on that. Let's just go and get that out there. So, but I'm going to give my opinion on it because I think it's a bunch of junk that these guys get to come in and buy all of our property up, or buy that families are wanting for investment. So.
You're on fire today, man.
That's just the way it is. Right? I mean, I wish they couldn't, I have a lot of my own opinions like that, but I agree with Phil. I wish they'd put a huge surcharge on it, but it wouldn't even matter because they don't use our money. They don't use Fannie money.
Yeah.
That's the thing, is they're using their own cash.
Yeah.
They're
Well,
buying neighborhoods at a time. I mean, they're buying 200 and 300 units.
well, I can say that they were. You're not seeing that happen much anymore. I think I was telling you about that. What was the article? The $10 billion neighborhood. It was something that Progressive Real Estate bought just tons of properties out in Laverne.
Yeah.
And it wasn't. There was. I think this is a bit of an exaggeration, but there were a few streets out there you could drive down. There wasn't a Progressive owned home, and all they did was buy the places, rent them out. And so now recently they've been selling them off, I guess, is what's been going on.
I know two builders that basically don't deal with the public anymore. They went from having they've been like a local builder doing moderate number of units per year, and now they don't, it's like they disappeared, and they're not disappeared. They're just building for these people. There's not even.
They're building homes for rent.
Yeah, they just basically hired these building companies. Oh, well, go build me 100 houses.
No kidding. I know that's happening a lot. That's happening a lot down in in my neck of the woods on Carruthers. There's a lot of that stuff going on. Anyway, boy, what a whew.
Look, Andrew used to live in Westwood, right next to Beverly Hills. Let's go, Beverly Hills. I've never been to Beverly Hills, but I'd be like oil and water down there with big Rodney walking down the sidewalk with all those. I couldn't imagine what the you just imagine all these beautiful ladies walking around with crazy $10,000 purses. I'm like, okay.
We could go down there as a group and do what Philip says. Add sunglasses. We could all wear sunglasses, a tank top, and walk down Rodeo Drive or something.
Yeah, no doubt. Yeah. And then, somebody's asking me about financial advice. Okay.
Yeah. No. We could do a road show.
Yeah.
We could do this on my Mac. No. Mm-hmm. Oh man. Well, I tell you, how fun was that? Listen, I thank you for all your input on that. And I think that if I were to, I'll do my version of the wrap up of the show is, things aren't as bad as they see. If people are trying to make it seem, things are good. I think that we're going to be just fine. The economy seems to be settling into a groove. I think we started off the show, as long as there's not big, huge variations, I'm pretty happy. I think we're going to be okay. What do you think?
We are okay, and in my opinion, we're trending in the right direction.
I agree.
I was talking with my assistant earlier, And he missed out the first time around on trying to buy a house when I was like, he got put out of the market by all this crazy bidding and stuff like that. And, and I told him the same thing. He is like, yeah, it's just not a good time to buy right now. And I said, it is a good time to buy right now. I said, it's not, I know him in his significant other situation. I said, it's not a good time for you to buy right now. But I said, but market wise, it's a good time to buy right now.
Mm-hmm.
And I told him a story. One of my first loans I ever did when I got in the business, did have a really good friend of mine. And of course, I was as smart then as I am now. And I said, you're never going to refinance this 7% rate. I said, I don't think we'll see rates lower than 7%. And of course, after I said that, it went for 20 straight years over 7%. And it's like, that's why it's bumping up against 7%. It's because I said it would never be lower than 7%. So that's just the cosmic God's telling me that how wrong I always am. And just
karma, baby.
You'll never go above that. So.
You had some great advice on that. I just, and we're going to have to do some more of that reaction stuff. That I think that there's a lot of information out there maybe we just don't need. And so we'll do our little part in our corner of the world to try to change that. So that's what I got to say. Any final thoughts there, Mr. Wilds?
No, appreciate everybody listening in today and offering their feedback. Yeah, and don't set me up either, Andy, getting these people with tank tops and stuff, because it's going to be an easy target. I'm liable to say something off color, so protect me a little bit.
Well, we're not monetized yet anyway. We'll worry about that when we get monetized. Yeah. All right, buddy. Well, we'll see you next Tuesday. Angie, Chick-fil-A. Chick-fil-A is the best. Angie, Philip, thank you. Wendy, I know you're hiding around there someplace. Mr. Angie's husband, I hope you get better. And thanks a lot. We'll talk to you next week. So let me find the right button. See you guys.